Hey there, everyone. Welcome to Chart This with Dave Keller. Happy Thursday, March 20th, and thanks for joining me here on our daily market recap show. We're coming to you from a kind of drizzly and classic March 20th kind of day here in Redmond, Washington. Hope you're doing well and staying safe and enjoying life wherever you are at. Sort of an interesting kind of choppy day today. We haven't had a lot of days where it's been almost mixed between sectors up and sectors down, but this is one of those days. Some earnings. This isn't sort of the meat of earnings season, but we're seeing some earnings related movements come out. So we're going to spend a little time in the chart review portion going through some of the individual charts. Companies like Nike, Micron, Newmont Mining, FedEx, Lennar, a good home builder. A number of kind of interesting themes to tease out here. So we'll take a look at all of that all that information. You know, again, did you see anything today? At least did I see anything today convincing me anything other than a counter trend rally? Like, still not yet. And again, I think that's one of the joys of being a market strategist, which is what I do. Is you have to look at every day and then just sort of try to put it into context and think about what it might mean on different time frames. And for me, this still reads very much like a counter trend rally. However, some of the bounces have been fairly significant, right? If you have a small, time frame, a minimal time frame, or a short-term time frame, plenty of swings to be had. So if you like price swings, if you like volatility, you probably love March of 2025. With that in mind, let's get to the market recap and see how things played out today. And again, I appreciate you guys so much tuning in live on LinkedIn, on X, on Facebook, and on YouTube, which are the four platforms upon which we're streaming the show. It's been awesome to see more and more tuning in live every day. And I'm so thankful those of you that are. Put questions in the chat of whatever platform you're on. As we go, I can see all of those on the live streaming platform here called StreamYard, which is a great platform that I'm enjoying a great deal. And assuming I don't completely disrupt the audio like I managed to do yesterday, we will have a great conversation. But I'll take a question or two at the end of the episode. We are planning an all mailbag episode tomorrow after a brief market recap, and would love to answer all of your questions, or at least as many as we can get to when we have a little more time and space to do it on a Friday afternoon. All right, let's look at how things are playing out here after Thursday's session. So the S&P, I mean, a lot of red here on the front page. The S&P down about 0.25% to 5663. The NASDAQ Composite a little bit worse, down about 1/3%. So these are not big down days, right? To be clear, this is sort of just a slight downgrade from yesterday's close. I think what's more interesting than the direction of the close is sort of the contour of the day, if that makes sense, right? Here's the S&P opening lower, trading up, I mean, almost exactly to yesterday's high. I don't think things like that are an accident. There could be a coincidence to things like that, but I tend to subscribe more to the things probably happen for a reason with that sort of thing. Having spent a lot of time with a lot of short-term traders, you always are looking at to the left to look for key pivot points, key inflection points, levels at which you might anticipate buyers or sellers coming in, profit taking new positions. 57.10 kind of looked like the level after yesterday. So we kind of opened down at yesterday's afternoon low. We traded up to yesterday's intraday high about an hour into the session. And then the whole rest of the morning and most of the afternoon was in a downtrend. Only 2:30 into the close did we rally a little bit. So, you know, that idea that we opened lower, there's initial buying, but then distribution through the course of the day, I think is an interesting takeaway from today's session. Mid caps and small caps all down, and the mid cap S&P 400 was the worst performer, still only down about 0.75%. That is about 0.7% lower. The VIX actually moved slightly lower today, not by much though, just about 0.10, right, 0.1 VIX points, so not much of a change. Speaking of the VIX, I did grab a chart of the VIX. I had a podcast interview earlier today with Jay Soloff, who's the chief options strategist at Investors Alley. I've interviewed Jay a number of times on different on Stock Charts TV and on my old program there. It was really cool. We actually talked all about volatility, and if you've never really understood the VIX, things like the VIX futures term structure, hopefully we did a very good job of taking things like that, which tend to confuse investors, And Jay did a great job of laying it out. And hopefully I asked the right questions to help you understand why those things are important. The term structure in the VIX futures have actually changed dramatically in just the last couple of weeks, something I was not aware of until I interviewed Jay earlier. Look for that episode out probably tomorrow morning. We're working on that, getting that edited up, and we'll get it out to you as soon as possible. But should be a good discussion. And my previous episode with Jim Poplava has been very well received. I'd encourage you to check that out. Great long-term investor, long-time money manager, just reflecting on what this period means for him and for different time frames. So check that one out for sure on our YouTube channel. All right, looking at interest rates, you can see the yield curve generally moving down today. This is after yesterday's Fed meeting, of course. It's interesting. A lot of the stuff that I read, just people that I kind of trust, reflecting on what we learned from the Fed. The general assessment was that the market reaction was not as negative as you would have guessed. If you listen to, Powell's comments, if you listen to the press conference, kind of a negative feel, sort of a, tariffs could be an issue. We don't know. He used that word transitory, which was last used, sort of in the COVID area at a time when inflation was definitely everything but transitory. It was the opposite of transitory, is more of a chronic inflation issue. So the fact that he sort of used that term in particular is kind of rough. So I guess surprise was the general sense that I got, which I think is fair. Reflecting on the language that we heard and sort of the additional data points, suggesting a rocky road ahead and a lot of uncertainty. I think reinforcing the challenges we've been running into. So Powell's conference certainly, seemed to encourage investors, I guess. But boy, again, if you didn't look at the market reaction and you just read like the transcript, you'd probably assume that the market was down based on that. So I think that's a bit of a head scratcher as we make sense of we try to make sense of what we learned. So yields generally moving lower today. The 10-year yield is right around 4.25. 5-year point just above 4%. The bond prices using the TLT, not real change from yesterday, although we opened a lot higher, and that sort of unchanged kind of came after a big downdraft through the course of the day. The dollar index actually ended up just slightly higher from yesterday. Not a big change there. Looking at commodities, we can see gold and silver both down. Gold slightly lower, right, just about 0.1%. Silver about 0.8%. Copper flat. Crude oil prices higher, and energy actually had a pretty decent day. And again, that's been an interesting rotation here, right? You're seeing energy stocks actually starting to improve, and really with oil prices arguably not justifying that. For me, I always think of energy. I don't have a problem with analyzing energy stocks using technical analysis. I'm a big fan of that in any situation. But certain sectors, like a lot of materials, like gold stocks, like energy, companies with crude oil. It really is a play on the commodity because the revenues of the companies are so tied to that commodity, right, and the price of that commodity. So you're really making a bet on where you think that commodity is going to go. And energy, if you're buying energy stocks, you're I guess pricing in, or you're assuming that crude oil prices go up from here. I would argue that the chart of crude oil probably doesn't justify that optimism yet. Arguably it's the fact that it's so low, and how much lower is it going to get, I would say is probably the argument there. All right. That was a bit of a digression there. All right. Looking at cryptocurrencies, a lot of red here generally. Bitcoin down almost 3% today. We're around 84,500 right now as we go live with the show. Bitcoin did get up to about 87,000 as we were doing the show yesterday. And then today, through the course of the day, kind of coming down along with other risk assets moving to the downside. Ethereum prices back below 2,000. We sort of have been trending lower through the course of the day. So cryptocurrencies generally have been trending lower in the last 24 hours. Again, sort of a risk-off move. I did grab the chart of Bitcoin, I believe, for the chart review. And if you're ever wondering why I often say I think I grab something, what happens is through the course of the day, I look at hundreds of charts for a lot of different reasons. And anytime I see something that I think would be interesting, I put it on a list. And then right before the show, I kind of reorder them and get them so that it makes sense, so that we can have a conversation. Then I go through it, but I often forget something I put in there a couple hours ago. That's why I love platforms like stock charts. You don't have to remember. You just put them in a place, and then they're there when you're ready for them. All right, looking at the 11 S&P sectors, I mean, sort of a mixed day, I would say, in terms of returns. A lot of days recently, it's been sort of like everything up or everything down. Today, a little more mixed, a little more a sign of indecision, I would say. Utilities, your top performing sector, still only up about 0.4%, about the same for the XLE, the energy sector. After that, financials up 0.1%, healthcare basically flat. So those are your only four sectors in the green. On the downside, technology, materials, industrials, and again, not by much. I mean, this was not a big directional day. There was some movement intraday, but by the close, not much of a change from yesterday's close to today's close. To be honest with you, it netted out sort of a flat, choppy day here. Looking at breadth overall was more negative than positive today, right? So you have on the S&P, which is where I usually start, 63% down, 36% higher, about the same for the NASDAQ composite. No real change there. Mid caps, you see, about a 3-to-1 ratio of down versus up. New York Composite Index about the same as the S&P and the NASDAQ. So, so generally more stocks down than up, or as we would say here, more decliners than advancers. Those cumulative advanced decline lines broke down, during that February sell-off. They bounced a little bit. Most of them still below. I think all of them actually still below their 50-day moving average, which tells me we're still, the breadth data is still bearish. And you would need to see an improvement before you think of, personally, before I would think of those as anything but bearish at this particular time. So this sort of day just reminds me that there's a lot of things generally going down. And that's within the context, again, of our market trend model being net negative on the medium-term time frame, which for me is the most important time frame to watch. All right, looking at the meager 7, we will call them today. NVIDIA actually up today 0.9%. And again, you're not going to find a lot of huge moves. Until we get to the heat map, you'll see some stocks actually moved quite a bit. But at this high level, the major indexes and the big names, not a ton of movement. NVIDIA up 0.9%. Meta and Tesla both had slight up days. And for Meta, that's important because that's one of those names testing the 200-day moving average. And again, I think a stock testing a 200-day is important because a lot of people are going to be focused on that as a potential area of support, which means if that holds, that's really encouraging. And again, it's not just Meta. I mean, there are a bunch of stocks sort of testing the 200-day moving average. Royal Caribbean testing its 200-day. I actually wrote an article earlier today for CNBC Pro about RCL. Carnival Cruise Lines actually reporting earnings tomorrow, I think. But talked about RCL testing the 200-day along with some other things. So if you follow my work there, check out that article from earlier today. But the other problem with something like Meta and its 200-day, what if it doesn't hold, right? What if stocks like Meta don't hold their 50-day or their 200-day moving average in this case? That's been a problem. And most of the Magnificent 7 names went from above their 200-day to below it, which suggests that kind of garden variety dip buyer is no longer buying the dips. That, consistent source of demand that kept prices going higher in 2024 is no longer there. That buying power that would come in and sort of accumulate shares on a higher low, we're not seeing that, right? And that's been arguably one of the biggest changes from late 24 to now early 25. Almost done with the first quarter of 2025 here, right? Next week. All right. On the downside, Netflix down about 0.9%. That's been by far the best of the charts within this group. Not even close. It's been the best performer. So Netflix, pulling back additionally here. Alphabet and Apple both down slightly, about 0.5% to 0.7%. All right, we are going to go to the heat map, the market carpet, as it's called on stock charts. This was a very neutral day, right? I mean, the key word is neutral, I would say. And again, what you found is a lot of stocks moving and chopping around, major indexes chopping around, but by the end of the day, not a big directional move. So what that means on the heat map is the average color is kind of neutral, amber to beigeish, which means the big up days and big days kind of jump out at you, which is what I love about this kind of visualization. You can focus, ignore kind of the bulk of things, which kind of did what the market did, and look for the outliers, because that tells you there's something either company specific or industry specific or something that is creating a something different, right? Some different movement. And whether something's up a lot or down a lot, it tells you there's something unique to those particular names, like JBL going up 3% while most things were down. Like those are the kind of little moves which can tell you there may be an opportunity, which is not a all stocks are going up kind of opportunity, but this particular stock at this particular moment is of interest. So what strikes me on the heat map, besides just the general neutral color, is a lot of bright red in a lot of different places, particularly in semiconductors, right? Microchip down 6.5%, Empower down 3.3%. What else? SMCI down 2.5%. That's not a big move relative to general movements there. IBM coming down about 3.6%. I did grab the chart of IBM because I would argue we've seen a breakdown now in the last week. IBM's one of those that had a really good uptrend into February. Really from January through early March has been sideways, and now arguably starting a new distribution phase, I would argue. ACN, I saw the news related to Doge. This is one of the first companies sort of dealing with a bunch of contracts being canceled, supposedly. Was the quick headline I read. I kind of scramble and read as many headlines as I can before we started. I shouldn't quote a headline that I haven't done too much digging on, but I did see that name was mentioned, which sort of explained the stock down quite a bit. Within consumer discretionary, I'm seeing like Decker's Outdoor, which has not been a great chart. I mean, it really made a new high at the end of January, and it's been essentially in a free fall. So just continuing to move to the downside there. Caesars and other gambling names, you'd love to see a nice upside follow through, and we haven't seen that. We've seen like little spurts of upside movements, but the longer term trend has still been generally lower. I think that's it for the heat map today, to be honest with you. I mean, generally in this kind of day, I like to focus on the names that have moved a lot. The Magnificent Seven names were kind of non-factors today, for what it's worth. And there's a lot of things sort of lower down in the cap scale that were actually making the biggest moves. All right, I'm going to see if you still get the audio because I think I fixed it, but famous last words. All right, I hope you can still hear me because we're talking about the webcast I'm going to be doing it next week. It's called Relative Strength. Top performers make top portfolios. We'll be looking at a bunch of general ways that you can approach relative strength investing, what it means to look at stocks relative to their sector, their industry, and the benchmark, and look at a bunch of examples. Talk about which areas of the market are showing the best relative strength now. You can sign up for this free event next week on Wednesday, March 26th by going to marketmisbehavior.com/relative or scan the QR code that you see on your screen. Should be a lot of fun. We've had a lot of fun with these webcasts here over the years, just hitting on key themes, focusing on different parts of the technical toolkit. And I think this is a really good time to focus on stocks showing good relative strength, which in a down market is where I've often encouraged people to focus. So I hope you can join me for that free event coming up a week from yesterday on Wednesday, March 26th, 1 p.m. Eastern, 10 a.m. Pacific. I think that worked. Go me. All right, let's continue on looking at the chart review. And so what we're going to do, I actually grabbed a bunch of charts here, so I'm going to go a little more quickly than normal, just to make sure we get to all this content. As I was looking at stocks reporting earnings today, a bunch of interesting technical setups. And I think when a company reports earnings, it's a really good time to think about the chart because it tells you a lot about sort of the sentiment going into an earnings release. It helps you understand and put whatever gap or move you see related to earnings, puts it into context of what the sentiment has been going into earnings. And then it's the perfect way to evaluate what investors are thinking about the company post earnings. So pre-earnings, at earnings, and post earnings, I think charts are really, really valuable. Just to think about key levels and key signals and key movements that help you understand what investors were thinking would happen. Were they surprised? And then how did they digest that earnings release? So we'll get to some of those here in a moment. Before we get there, just talking about the S&P 500, right? Testing 5,500, we're getting what I would still describe as a counter trend bounce. I think that makes a ton of sense here, having a big bounce off of a key downside objective, which was reached. The S&P was oversold for the first time really since being, almost briefly oversold there in early August of last year, which ended up being a pretty decent low. After a 10% drop, we had about a similar drop and we became oversold. So I have people sort of revisiting this as a potential analog for what we might see here. And hey, you might be proven right. I don't know the future any more than you do. All I can do is look at the conditions here versus the conditions there. Certainly a different world in so many ways. I mean, and again, my interview with Jim Puplava ended up being a big political discussion in a lot of ways, just talking about different political tailwinds and headwinds. And I think that's the reality. It's not something we were sort of thinking down the road about who might win the election and what that might mean, but it wasn't real and tangible. Now we're getting, a flurry of headlines with significant changes to, to foreign policy, to, all sorts of things, right? The general structure of government and so forth. So I think that paints a very different picture of the environment with which we're able to analyze this particular counter trend move. So getting back to the chart, what does this mean? Again, very easy. I think with this sort of move, it's good to define a line in the sand. And here's what I would say. Anything below 5,500 is probably not bullish. And I would argue it's probably very bearish. And for me, that would immediately suggest a move to like 5,100 to 5,150. That would be my downside objective if and when that's broken. So that's number one. If the S&P is able to power above 5,750, which would get us above this Fibonacci resistance level and the 200-day moving average, I would argue that's pretty constructive. For me personally, I'm probably going to give the market to 5,850 before I would throw in the towel on the bearish positioning and really start to think more on offense. But until then, as long as we remain within this general range, I think this is a neutral rating, right? This is a wait and see moment. So, long positions that are still looking good, right? Charts like gold, I'm not going to sell just because I have a macro view. I'm going to continue to hold those as long as they work, and I still have them. But if, again, as we, and so holding in this basically means just hold. We wait and see. We sit on our hands. We wait and see where there's the move to the upside or the downside, and then follow it there. So the direction of momentum coming out of this little range here, I think could be really important. That's what tends to happen when you have a major support level that's now been confirmed. We have, we're below a very important moving average that I think a lot of people would be looking for. And it's so, if you look at enough charts for enough years, breaking below a moving average, testing it from below before the next big leg higher, I've just seen that so many times that this looks like such an obvious counter trend rally. And the way that you tell that that's not it is you blow right through the moving average like it's not there. And we've not seen that yet. It could happen, but we've not seen it yet. So for now, I wait. Now, the Chaikin Money Flow I mentioned a couple of days ago, maybe earlier this week, and I would say wanted to just continue to highlight it. How is the Chaikin Money Flow continuing to go down? Because even today, the market wasn't down a ton, but the Chaikin Money Flow is still negative. Which you have to remember, something like Chaikin Money Flow, it's all about where we close relative to the high and the low. And I think the way that indicator is calculated is just ingenious, because a day like this, where we close more at the lows of the day, the general philosophy is the distance from the high to the close is kind of distribution volume. The distance from the low to the close is kind of accumulation volume. So when we're closing near the lows, most of that day's volume is negative. When we close near the highs, most of that day's volume is bullish. And so, recognizing days like this, where even if we close up on the day, we didn't just close much above the midpoint, that suggests that, that again, it's just not a big accumulation day, right? Your big accumulation days, you close near the highs because there's just more and more accumulation going into the close. We're not really seeing that phenomenon. So it's sort of a weaker volume trend, even though the price is going higher, is the way I would describe that, using the Chaikin Money Flow as the vehicle there. The VIX, and I mentioned my interview with Jay Soloff, hopefully coming your way very soon, later today, maybe tomorrow morning. We'll go through that, but it was a really good discussion about the VIX. We talked about the VIX level of 20, and Jay agreed with what I've often said, is that the 20 is kind of the level, and above 20 is a volatile environment, high volatility. Below 20 is a low volatility environment. We're literally right there. We are at 20. In mid-February, we're down around 15. There in early March, we're up to around 28 on a closing basis, intraday basis. We moved a little higher. And here we are now kind of right back in the middle, right around 20. So again, the VIX is almost showing a period of indecision in so many ways. So, whether the VIX is able to remain below 20, which would suggest more of a risk off kind of, or excuse me, a risk on sort of low volatility, low worry kind of environment, I think that's pretty important. For now, it's still holding that 20 level. All right, survey data comes out here on Thursday. A lot of the survey data that we track is weekly. So these are some sentiment indicators. We'll look at the AAII survey first, and then the name exposure index. No big change to the AAII survey. This is a weekly survey of individual investors asking, are you bullish, bearish, or neutral on stocks for the next 6 months? And again, one of the fascinating things I've observed, having studied this indicator for a number of years, at worst, it doesn't get much below 20% bulls. No matter what, there are 20% of the respondents that are just always bullish. And I respect that greatly, that it doesn't matter. And again, if your runway's long enough, that's the place to be, right? If you're going to be bullish or bearish for your entire life, be bullish. Trust me, because you're going to be right more than you're not. And generally, the market tends to be going higher. Average year is an up year for the S&P. But those drawdowns can be painful, and remaining bullish when the charts tell you clearly not to be is what I'm not a huge fan of. And so that's where I would question, people still super encouraged based on what we're seeing here. Having said that, 22% of respondents bullish as of this week's reading, still about 58% bears, which is a very low number. These are, pretty negative bearish readings. So generally, the way you think of this is a contrarian syndicator, right? It's an indicator. So when sentiment is so negative, it almost suddenly becomes bullish because everyone's bearish. So there's nowhere to go but up. But I would just point back to like 2022 kind of years. Sentiment can get negative and stay negative for quite some time. And so that's the danger now is just the beginning of this period of negative sentiment. The name exposure index did continue to drift lower. So actually for the last 5 weeks, the name exposure index has been getting lower and lower. That's not true. The last 4 weeks, that's the number. We've been getting lower and lower, down around 65%. Not crazy low, but definitely below, what I would consider a bullish allocation. This is a weekly survey of money managers, basically asking what their position is, what their weighting is to the equity markets. It can be over 100. It rarely does get more than 110 to 115%. It could be net negative. It has very rarely gone below zero and been net short, although it's happened. Even in 2022, it never got below the zero level. It's down a bit. And it's been down the last 4 weeks in a row here. My podcast interview last week with Ryan Redfern, go listen to that one. If you want to learn more about the name exposure index, he's actually the president of NAME. He votes in this survey. And I was able to ask him, how do you think of it? What does it mean to you? How do you compare this one to the AAII survey? So if you want to dig more into some of those sentiment indicators, check out that interview with Ryan Redfern. It was a lot of fun. Bitcoin actually managing to hold steady here. And I would say Bitcoin in the short term has been essentially range bound between around 77,000, we'll call it, and 87,000 here in the last couple of weeks. Now, the general trend in Bitcoin has been down. We've been making a pattern of lower highs and lower lows generally since mid-January. We're right around the 50% retracement of that September 24 low to the December 24 high. We did break below kind of a key line in the sand, just like the S&P did. Bitcoin did as well in late February. That was one of the many things telling me, boy, we're really breaking to the downside. One thing I observed, which I wanted to highlight for you, a bullish momentum divergence. We had lower lows in Bitcoin from late February to early March. We have higher lows in momentum, which does imply maybe we're at a bottoming point as we get to a 50% retracement, right around 80,000 for 80,000 per Bitcoin. We're trading higher, and as of the last 24 hours, we've gotten back above the 200-day moving average. As of right now, we're literally almost right exactly at the 200-day moving average. I would love to see the momentum improve. The RSI hasn't been above 50 since the end of January. I would love to see us regain the 50-day moving average. Those are the kind of things that would suggest an upside follow-through. That would also take us above 90,000, which would all be encouraging. But for now, it's sort of stalled sideways. In full disclosure, I do own Bitcoin. All right, looking at offense versus defense, I just want to show you that, what do these ratios do in a downturn, right? So the ratio of offense to defense, or things you want versus things you need. One of my favorite ways of just tracking investor sentiment and whether we're putting bets, kind of betting risk on or risk off within the consumer space. It's a ratio I followed for quite some time. And you can see that the cap-weighted version made a peak in January, has been trending lower into March. The eco-weighted version actually peaked out in early February, again, trading lower through early March. What's happened in the last week as the S&P and the NASDAQ have made a bit of a bounce higher, these ratios have slightly moved higher, but not by much, right? And I would argue the trend in these is still pretty much downwards. And so, until you get a nice improvement in these ratios, look what happened in July, August, right? They went down, but then all of a sudden a higher low in September, and all of a sudden the ratio clearly turning higher. So by mid-September, it was pretty obvious that that was a rotation. That's not what we've seen yet. And so again, when you think about this as a pullback and then and looking for the next big leg higher, indicators like this will often confirm, yes, we're in a recovery phase. And I'm not seeing that yet, but I think that's why it's a chart that's important to follow here. All right, IBM, not an earnings name, but I did want to just highlight the chart because IBM for me is maybe an example of upside exhaustion in the technology space. Look at the gap higher in late January. That was on their earnings report at the end of January. From there, that was pretty much it, right? We made some slightly higher highs, but that gap higher was pretty much it. You call that gap an exhaustion gap, which is when you have a big move and then you have a final gap, and then that's it. It's called an exhaustion gap because it's literally like the last gasp higher, and then that's it. We sort of have a stall here, a power on stall, no further altitude, and sort of a sideways basing pattern. And in the last week, we've really started to break below the lower end of that range, also below the 50-day moving average as of today. I mean, I think that, again, getting a follow-through day tomorrow sort of unlocks a downside objective to that January low, which is right at the 200-day, right around 212, 213 or so. If that breaks, RSI still above 40, so I think that's something to watch as well. But IBM definitely not going up anymore based on that analysis of trend, and arguably starting to rotate lower. So that's the kind of name that if I did have a position, and I don't, I would be lightening up by now because you're sort of no longer going up. And so this tells you that your capital is probably better in something that is going up. And the fact that we're breaking down tells me to start to lighten up as well. So that's how I would interpret that. All right, I have a weekly chart of FedEx just to show you. Again, when in doubt, zoom out is something I love to share. Early mentors of mine used to say that, and I think that's just a brilliant way of describing if you're struggling to make sense of the short-term trends and the short-term momentum, bring in way more data. If you're looking at an hourly chart, look at a daily chart. If you're looking at a daily chart, look at a weekly chart. Always go one level higher, bring in way more data, and then it'll help you put whatever's happening into longer-term context. When you do that in the chart of FedEx, which is reporting after the close today, I believe, we can see that on the weekly chart, we're really kind of testing the post-COVID high here, right? In 2024, we got up to around 310. That's pretty much where we were at the post-COVID peak. From there, we obviously had a big downside rotation, and arguably on the weekly chart, a clear rotation from higher highs to lower highs, from higher lows to lower lows, and right at the 150-week moving average, which is one of my basic kind of longer-term weekly moving averages that I track just to get a sense of sort of the secular trend. So I would say FedEx really starting to rotate higher. You'd really want to see some improvement from earnings. I mean, a nice earnings-related bounce could be really welcome. Let's take a look and see where we're at after the close today. Yeah, down another 5.5%, currently around 233. So that's taken us below the 150-week. And the daily chart, of course, looks a lot rougher than that. The daily chart kind of looks like this, where we're below the 50-day, below the 200-day, which is kind of flat. We're making lower lows and lower highs. And again, so I get people being encouraged because we're at the lower end of the range. But for me, I'm not seeing support as much as I'm just seeing a downtrend. And until there's an upside catalyst, I'm going to assume that's going to continue. So it looks like with tomorrow, we'll see further downside for FedEx. Let's keep going. Here's Nike on the daily chart, down about 1.6% today. This is another earnings release. I mean, the chart of Nike for me has been an underwhelming chart for so long. And if you look, this has just been consistently below a downward sloping 200-day moving average. And if there's one thing I have learned is things just below a downward sloping 200-day moving average, it tells you there's probably something somewhere else that looks a lot better, right? I mean, chances are that is not the best chart you could be in at any point. So it's just a reminder to go find a better opportunity elsewhere. Let's see what's happening after the close here. Down 3.5% to 69.37. So yeah, it's actually making a new low. It looks, we might still be kind of right above that February low. but it looks like a negative move post earnings. We'll see what happens tomorrow. Again, I'm just looking at the after hours sessions. I'm not a big fan of making broad decisions based on after hours trading, but in terms of like indicative levels, indicative signals about what's happening, post market around earnings, super helpful, right? And it's the best data you can get at this particular moment. Here's the weekly chart of Lennar. I showed a couple charts ago with FedEx kind of testing the 150-week moving average. The daily chart of Lennar and other home builders have been pretty rough. I think what's interesting about Lennar is we're getting really close to a buy signal using the weekly PPO, and you can see previous buy signals where the PPO indicator is well below zero, and we get a big buy signal. It's often a really good entry point, more of a sign of a nice cyclical recovery. Not there yet, and that's why the weekly chart's telling me to kind of wait and see as we look at a stock like Lennar. That's kind of the sentiment going in. Down a little more after hours, 116, which isn't that bad. That's kind of right around there. That's essentially where we were today on the daily chart. Not too much of a change there, but certainly we'll see if we eventually get a recovery. This is one of those where when a chart like this is in such a downtrend, I often just immediately go to the weekly chart and I watch the weekly MACD or the weekly PPO. And it's sort of like until that signals, let me go find other things that are in an uptrend. And then when that finally signals, that's when I start to look. Who was Larry Tentarelli, founder and editor of Blue Chip Daily, who's just a fantastic analyst, longtime stock charts user. He runs a screen for weekly MACD buy signals, which we talked about in an interview many moons ago. And he encouraged me, my conversation with him encouraged me to pay more attention to those signals. All right, Newmont reporting earnings today. Here's the daily chart of Newmont. I mean, gold stocks have been pretty good. And I own GLD and IAU in my own portfolios. I don't own gold stocks specifically that I can think of, but I do own physical gold basically through ETFs. And I would say Newmont is probably one of the least awesome gold charts because a lot of the other gold charts look a lot more like gold and they've caught up a lot more. Newmont is coming off of a higher low in late February and now sort of trading up to the upper end of there. Let's look at what Newmont is doing. Boy, maybe they're not reporting earnings. I thought they were. That's what I jotted down. Maybe I totally missed that. Nope, I missed it. Yeah, it's not until April. My bad. Never mind. Good chart though. We'll see what happens if it's able to hold that February swing high. Earnings are tough, by the way, and it's so funny. A lot of earnings calendars you look at, it's based on estimated earnings based on when the company has reported, but they can often change, and it's hard to keep track of that. So apologies for that. Micron testing its 200-day. Micron has not been a great chart. It's not been a horrible chart though, right? So a lot of things are breaking down. Micron made a low in early August and then has tested that low around 85 a bunch of times. It also has a high around 115. That high's kind of drifted lower following the 200-day moving average. You're kind of trapped between support at 85 and resistance at the 200-day. We're kind of trading up to the upper end of that. The RSI has been sideways between 40 and 60, sort of telling you wait and see mode. So it's not been a great chart, but it's sort of been sideways. There we go. We found a stock moving higher on earnings. That's good. Up about 3% to 106.22. So if that's where we would open tomorrow, that actually would clear the 200-day moving average. With something like this that's had so many tests of the 200-day, you'd want to see a breakout and then follow through. And for me, the concept of follow through is like an additional day showing you that it wasn't just a one-time whipsaw kind of fluke uptrend, but it was something more consistent. So maybe that is a nice bounce in Micron. That would be a big deal for the stock, which really has been, sideways for the last 8 or 9 months. Completely range bound. We could get above the upper end of that range. I think that'd be pretty encouraging. All right, final charts here, and then I'll take a question or two and we're done. United Healthcare. I'm showing the daily chart just to show what could probably be described as an exhaustion gap to the downside. We had a gap lower, and then look at how that ended up being the lows. Lined up pretty well with some previous lows in 2024 and 2025, and now we're seeing quite a bit of accumulation. The RSI right at 60, so it's sort of like a question mark. The weekly PPO, as I mentioned in a previous chart, in a chart like this that has been going down, I like to bring up the weekly PPO or the weekly MACD just as a confirmation that you're finally getting a bottoming pattern. Not there yet, but that's where the short-term chart kind of makes me want to look at the longer-term chart, bring in a little more data. When in doubt, zoom out. and just see if we can get some sort of signals there. So I'm encouraged by the fact that we're bouncing off of support. I like the bounce off of the lows on the daily chart. This is that support that you're seeing here. This is what those support levels look like on the weekly chart. So, I don't blame anyone taking a shot thinking, all right, limited risk because we put a stop below those lows, plenty of upside to get back to retest some of those ranges from late 2024. We'll see if there's enough follow through. But again, the weekly signal is something I would personally be patiently waiting for. All right. Great. I thank you so much for tuning in and for asking questions. Let's see. Ooh, I love this one already. Just glancing at the first moment, the world according to Ruben. Thanks for watching on YouTube. Hi, Dave. Isn't technical analysis a short-term market indicator as it's backwards looking while fundamental analysis is better for a long-term investment? If I had an unlimited, so my answer to your question is yes and no, right? So a little of both. Isn't technical analysis a short-term indicator? It can be. And I actually have a slide that if I had an unlimited amount of time, I would show it to you. I don't think for the life of me I could find it. I'm going to give myself 10 seconds, if you will bear with me, to see if I can track this down, because I had a chart where I was looking at the basically how much you use technical analysis based on your time frame. And if I could find it, that would be so cool. Oh, I can find it. Ready for this? Here we go. Nope. All right. I'm going to have to just fudge it because I can't figure out how to get the slideshow really well without completely torpedoing the live stream. All right. This is a presentation I did for the master students at Babson College last year, and I knew I'd put it in somewhere. So the answer is it is very good as a short-term indicator, right? So this is basically the way that I think about technical analysis in versus fundamental analysis. And I would say that technical analysis is valuable on all time frames. Short-term for me is a couple days to a couple weeks. Medium term is a couple months to a couple years. Long term is many years out or over a year. So the short-term time frame, I would argue fundamental analysis is not particularly helpful, right? You can't figure out what's happening in the next couple days on the chart of IBM by looking at their 10Q, right? Their quarterly report, right? I mean, the time frames are completely mismatched. So understanding what's happening moment to moment, it's much more about sentiment and supply and demand and fear and greed, which is why I would say technical analysis is incredibly valuable because there's just not much else. I mean, there's news flow, which is kind of outside of both of these, right? Just random one-off news that you can't predict. So in terms of understanding sentiment, you have to use charts, I would argue. And really the markets tend to mean revert. So you're better off as a swing trader. This is the swing trading time frame where you're buying weakness and selling strength. And just basically betting on the market mean reverting. The medium-term time frame, which is where I tend to focus, a couple months out, is really a trend-following time frame, meaning I think you use a hybrid of technical and fundamental analysis. You now get a couple quarters where you can think about trends in earnings and the potential of companies to grow earnings. But if you've traded for more than like a minute, you know that stocks don't just immediately jump to their fundamental valuation, which is what the efficient markets hypothesis would tell you is happening, right? The moment information's out there, the market immediately and in a completely rational way, we completely revalue the stock. Like that's total BS if you've actually looked at the markets at all. So I would say technical analysis helps you understand the trends and follow the movements from one fundamental valuation to the next. We don't go from point A to point B. We kind of do this. And so charts help you navigate that and understand when the market is mispricing the fundamental valuation. Over the long term, I would say charts and technical indicators are not particularly valuable. I think charts are helpful for illustrating market history and recognizing the business cycle and the economic cycle. But this is where stocks really do trade to their fundamental valuations. So depending on your time frame, technical analysis is almost the only thing you can look at to something that is an important part of a hybrid approach, which is where I would say most technical analysts, if you're not day trading, most technical analysts kind of focus here, particularly institutional analysts, because we're working with money managers that are trying to look a little bit longer term. But over the multiple years, I mean, big picture, I mean, charts are helpful for putting things into context and understanding market history and understanding when themes are coming in and out of favor. But it's not about pinpointing turns using technical indicators. That's more in these first two timeframes. So that was your answer. The fact that I was able to find a PowerPoint from last year is a true miracle. modern technology. But thank you so much for the question. Richard, one more question. Thanks for watching on YouTube. Dave, there is no more stimulus. Would you agree that markets were overstimulated and now need to adjust? I mean, undeniably so, right? I mean, a number of times, really going back to the COVID low, a number of people I talked to, and I remember Matt Maley of Miller Tabak being the first one that kind of mentioned where I was in a conversation where we talked about a liquidity-driven bull market, right? The Fed was injecting enough liquidity in the system to, I mean, literally force the markets higher. There's no way the markets were going lower given that particular, stimulus that was being provided. The world's very different now. And I would say there were plenty of reasons why the market was going higher. And I don't think it's as much stimulus, although interest rates and the interest rate policy was part of that. And arguably, rates remaining so low for so long. But I would also say it was the euphoria about AI and all these things that drove stocks to incredible valuations through the course of 2024. Great lesson to not, ignore stocks because they're overvalued. A lot of times I found stocks being overvalued just means we're going up a lot and the market has not accepted this new valuation level yet. However, at some point you have to sort of reset. And I would say what's happened now is it's liquidity is part of it. It's much more about uncertainty and instability. Markets like being like stability. They like certainty. They like predictability. Those are three words I would not use to describe the conditions in March of 2025. I would say unstable, relatively unpredictable, and very much uncertain. As a result, stocks usually tend to be pulled back in that particular environment until we get some sort of footing and we get a better sense of the future trajectory. I don't think we have that just yet. That was it for today, folks. Awesome questions, though, guys. Thank you so much for those thoughtful questions. Thanks for watching live. Thanks for making it interactive and making it a fun time together, as always. Those of you watching the replay on our YouTube channel, I appreciate you as well. Make sure you drop some questions in as they come up. We'll do an all mailbag episode on Friday of this week on the 21st, and we'd love to answer one of your questions on the show. Have a fantastic evening. I'm Dave Keller with Market Misbehavior. And remember, it's always a good time to own good charts. Have a good night, folks.